In this episode, I'm going to dig into how to evaluate a SaaS cash flow software company. By the end of this episode, I'm going to walk you through on how to exactly evaluate a deal, what a strategy to follow to reach the correct purchase price, and what factors come to the picture for evaluating a SaaS investment deal. Intro. What's up, everybody? Welcome to my channel. In this channel, I'm going to help you to be a better investor with an invincible energy. I'm thrilled today talking about how to evaluate a software deal and in particular, cash flow software business. And so buckle up for some serious insight. If you're new to this channel, welcome. I drop every single Sunday with actionable strategy and tactics on how to be a better investor, find, acquire, and run your cash flow software company. Be sure to hit that subscribe button and the notification bell. That's where you will get notified every single time I drop a new episode with Sam's energy. If you're part of this community, my people, welcome back. It's really awesome to see you over here. So if you're excited to dig in, go ahead and smash that like button for the YouTube algorithm, and let's dig right into it. Well, in this current landscape, understanding how to correctly value a software as a service or SaaS company has becoming essential and at the time becoming central, and then discussing it among private equity investors. If you're seeking a precise valuation, then we offer a complimentary assessment if you're interested. And here I can give you some advice on how to evaluate a software company. And there are two elements that comes into it. If you need to use SDE or seller discretionary. So basically this question comes with two fundamental questions. Should you look at the multiple of seller discretionary earning, SDE, or EBITDA, which is earning before interest, tax, depreciation, and amortization, or the revenue? Well, the disparity between the huge change in revenue multiple with unicorn SaaS enterprises and more conservative earning multiple over smaller companies, it's varies, and it's really complex in terms of valuation landscape. So it's crucial to understand the distinct SaaS companies embedded entirely different investment proposition. And looking at the cash flow software companies, it's really different entirely how to put a price, if it's private equity target or if it's a company that can be a VC target. So basically there are two ways to look at it, or three ways to look at it: SDE, as I mentioned, EBITDA, or revenue. So let's talk about multiplier on SDE valuation. And for a smaller SaaS company valued under $5 million, is often a multiple of seller discretionary earning, or SDE. And this is specifically applicable if the business is relatively slow growing and lacks in a real management team. And then the SDE represent basically the profit available to the business and to the business owner or the founder after deducting all the cost of goods sold, and also after removing the operating expense, and also owner's salary, and then divided by the owner's salary and dividend, and then the owner's salary and also some of the owner's expenses would add it back to the profit. Basically, in the simpler term, SDE serves as a benchmark for a smaller business valuation with actual earning potential. Given the most small businesses are owner operated and really rely on owner's involvement, SDE accounts for owner's salary, and associated expenses, providing a more accurate value that you can put to the business earning overall. And then if we talk about the EBITDA, which is as business expand, especially with more employees and varied management structure, the reliance on SDE diminishes because the larger enterprise, typically valued over $5 million, shift towards using earning before interest, taxes, depreciation, and amortization, which is EBITDA multiple. And this change create and signifies the need to reflect owner compensation and expenses into the business valuation. And then if you rely on revenue for valuation, unlike most businesses where either SDE or EBITDA is deemed to the primary proxy of future cash flow and then the valuation. SaaS companies present a unique scenario because the EBITDA generated today, even if it's zero, may not effectively project potential future earning for growing SaaS businesses. This disparity for the software enterprise, in which arises when the software companies invest significant capital upfront to expand their current EBITDA. With the recurring revenue model and sustained customer relation, profits are expected to surge in the future as the business mature and reduce spending on growth initiative. While revenue base as a good metric for valuing a growing SaaS companies, it's imperative to underscore that this valuation philosophy hinges entirely on sustained growth. If the SaaS business doesn't have the correct growth year over year, the anticipated revenue won't materialize, impacting the foundation of the whole valuation of the company. So if we go selecting between SDE, EBITDA, or revenue for the valuation, the decision between SDE, EBITDA, and revenue for a SaaS business valuation hinges on three crucial questions. Is the business highly reliant on the owner? Is revenue growth less than 50% year over year? And the third is, does the business generate less than $2 million in revenue annually? A positive answer to any of the above implies that a SaaS business is better suited for valuation using SDE. Investors are likely to assess the business primarily based on the benchmark, applying multiple to determine the final valuation. If the answer is negative, EBITDA or revenue might be more correct to use. And if you look at the multiple, basically determining the multiple is a pivotal aspect influencing by different factors. Determining the multiple is the pivotal aspect because influenced by different factors related to the business. Factors such as financial, traffic, operational expenses, and ultimately converging on the scalability, and then how transferable is the business and how sustainable, and some other important values such as retention. So we use a internal valuation model and we analyze between different data points, like 50,000 data points, to come up with the right valuation. And we use some modeling like DCF. And also we analyze valuation based on some different modeling such as DCF and historic pricing, the historic revenue, and we analyze it on a comprehensive evaluation. And then for now, better question is what SaaS metric to use to come up with the valuation. Well, SaaS companies typically fall within 4x to 10x on annual profit STE range. And then that comes with a multiple of metrics in the beginning of the assessment. And then that way we can filter these variables, and then that helps us to determine whether a SaaS business or a SaaS company multiple goes towards the low or premium end of valuation spectrum. And these metrics influencing valuation includes the age of the business, longer track records, demonstrate sustainability and predictability, and also number two, owner involvement, passive or predictable income model are more attractive. And then the third is growth trends, consistent and modest upward trends fetch premium multiples. And the 4 is its churn, customer metrics, or churn, lifetime value of the customer, customer acquisition cost, impact of quality of revenue, and then number 4, funding status, if funding influence, and then the funding status, which is if the funding influence valuation with public SaaS companies often receiving higher multiple, and sometimes you compare it between the public companies and the private companies. So basically to come up with correct and basically coming up with the value of a cash flow software company demands a nuance of understanding of the business, its growth trajectory, and the metrics that shape its financial landscape. So private equity investors should navigate this landscape with a comprehensive approach, considering factors ranging from the business reliance on the owner or its growth trends and funding status. Holistic evaluation, and basically looking at all these metrics and ensure that well-informed decision-making process, and then coming up with well-informed decision-making process in ever-evolving SaaS industry. So if you're starting to see the power in this, can I get a yes in the comment below? Also, smash that like button for the YouTube algorithm. YouTube loves it when you do that. So understanding the value of software as a service SaaS company involves into unique metrics and considerations, as each SaaS business has its own distinct priorities, while the broad valuation drives remain essential, and a deeper analysis for business model, specifically specific factors that significantly influence the final multiple that can influence the business overall. One crucial factor is the Rule of 40, a metrics that says that the SaaS company should have a combined revenue growth rate and profit margin of 40% or more. For instance, if a company achieves a 30% year-over-year growth rate alongside a 10% profit margin, it aligns with the Rule of 40. The choice of the right profit metrics, whether operating income or EBITDA, depends on the nuances or the business model. However, it's important to note that the Rule of 40 might not be universally applicable. Newer companies focusing on too early crucial growth potential, leading to lower valuation due to the perceived failure to deliver the high growth. Another influential aspect of the business model on SaaS valuation multiple is the degree of owner time and influence required to run the business, and how owner plays a central role for driving the revenue multiple. And then what are the SaaS metrics for investors? Private equity investors that they want to acquire SaaS businesses emphasize on certain metrics to identify the strength and differentiate the business. So some of these most metrics or crucial metrics for SaaS are churn, which is an important driver of valuation, and that factors the impact of perceived future cash flow of the SaaS business. Its significance relies on its own long-term implication for the business. To less explain it more, consider two companies, one with 5% and the other one with 20% annual churn rates. And on the construct, after over a decade of, and then 5% and 20% churn rate, after you compare it for example, for a decade, you can see how the revenue and profit changes over the time. And then the other metrics is customer acquisition. And then the other metrics is customer acquisition cost, CAC, which is how much the company has spent to acquire one customer. And the other one is the lifetime value. And the other factor is the customer lifetime value, LTV over CAC ratio. Also, which is really important, you usually want 3 times gap, and you usually want 3 times ratio would be 3 times. So you have So usually a perfect ratio is 3. So you have a little bit of gap. If the CAC goes up, you have time to get the LTV and capture the value of each customer or of. So if the CAC goes up, then you have time to capture the lifetime value of the customer. Other factors to consider when evaluating SaaS companies: customer acquisition. As I said, what are the distribution, how you're getting the customers, and what channels you're using. If there is customer concentration. If there is customer concentration, if there is any big customer that holds a big portion of the revenue, and then the other part is the competition conversion, is the channel competition, how's the market, how's the competition, are they big players in the market. The other one is product life cycle, how long this product is going to stay in the market, and then how long the customers use it. And then the other part is the technical knowledge, competition, and how rare is the product, if there is any specific technical knowledge to be able to run a product and the company. And as I said, the general rule of thumb is an LTV to CAC ratio of 3 is ideal for most SaaS businesses. And then that way it allows for somehow a cushion to a dip in the LTV and or increase in a CAC, and then that way you're able to generate a healthy gross profit margin. In conclusion, the ideal SaaS market has the blend of science and art, and then providing a fundamental understanding that is comprehensive and consider all the factors like competition, user behavior, and adaptability and of existing solution to the market demand. Competition, users' behavior, and adaptability of existing solutions to the market demands. By combining these elements, can only identify and thrive in markets that's not only promise growth, but align with the dynamic landscape of SaaS industry. And that's a wrap for our deep dive into how to value a software SaaS company. Remember, should we go based on SDE, EBITDA, or revenue? And we talk about it, and we talk about the factors that has major roles in this calculation, and how to come up with the purchase price and evaluate it. So if you got a value from this video, please smash that like button for the YouTube algorithm. It loves it when you do that. I put a lot of love into these videos. I put a lot of work in these videos to make sure you get value. If you have a fellow investor or a SaaS founder, if you're part of a WhatsApp group or Slack group of other founders, other investors that you think they would get value from this video, please share this with them. It just means the world to us. Also, I drop an episode every single Sunday with actionable strategy and tactics, with working with one-on-one investors like you, and also operating my own SaaS company. Be sure to hit that subscribe button and the bell icon, and you'll get notified every single time I drop a new episode. And lastly, remember, stay strategic, stay informed, and happy investing. I'm Sam, and I will see you in the next episode. Take care, everybody.